Welcome to the Opening Bell Report.
Okay, I have to start today with a chart that, honestly, it looked like a glitch in the matrix.
I know the one you mean.
You know how it is? You're staring at screens all day, you get used to the rhythm. A stock moves 2%, maybe 3%.
Sure, big days, 5, maybe 6% on a huge earnings beat.
Exactly. But then you look at ENPH's energy ticker, ENPH, on February 4th, 2026.
Yeah.
And it didn't just move. It effectively teleported.
It was pretty hard to miss, a 38.6% jump in a single trading session.
38.6.
Yeah, closing just under $52 at $51.67. And that is a massive, massive move. This isn't some penny stock behaving badly.
No, this is a major energy player.
Yeah.
I mean, ENPH hasn't done something like that in years. It feels like we've been talking about the solar winter forever.
Oh, for at least 18 months. Just this gloomy, depressed period for the whole industry.
Where interest rates crushed demand and inventories just piled up to the ceiling. And then suddenly,
Ooh.
boom. The question on everyone's mind is it over? Is winter finally over?
It certainly feels like a thaw, feels like the first day of spring. But, and there is always a but, when you see a vertical line on a chart like that, this rally has left a lot of, let's say, traditional value investors just scratching their heads.
Right. And that's the mystery we're here to unpack, because on paper, this doesn't make any sense. We were looking at a company trading at a price-to-earnings ratio, a PE of over 40.
Over 40 times.
And usually when you pay that kind of premium, you're paying for explosive growth, right? You're buying a rocket ship.
Exactly. A high multiple implies high growth expectations. You pay up today for earnings you expect to, double or triple tomorrow.
Right.
That's the logic.
But ENPH's revenue is actually down year over year.
Yeah.
So you've got this scorecard, price skyrocketing, a valuation that looks incredibly expensive, and sales that are shrinking.
It's contradictory.
To me, or to any sane investor, that sounds like a classic bull trap. Like retail is getting suckered into buying a dying star just because it had one flashy day.
It really does look that way, but only if you look at the headline numbers. The analysis we're diving into today argues the exact opposite.
Okay.
It suggests this isn't a trap at all, and that the smart money, the big institutions, they're piling back in for very specific reasons. And the core argument is that 40 times earnings might actually be, well, cheap.
Cheap. At 40 times earnings, the S&P average is what, 20?
Yeah.
That is a bold claim. You're going to have to convince me on that one.
It sounds like fuzzy math, I know.
Yeah.
But it actually checks out if you change your perspective on what you're measuring.
All right, well, that's our mission today then. We're going to look under the hood of this Q4 2025 earnings report and this analysis. We need to figure out if this is real or if it's just hype.
The report lays out 3 pillars for why this is sustainable. We're going to break down that valuation paradox, check the plumbing of their inventory channel.
Which is way more interesting than it sounds, I promise you.
It is, and we'll look at their cash position. But really, we need to get into the psychology of this move. That 7% jump isn't just about math. It's about certainty.
Okay, so let's start there. The elephant in the room, the valuation. If I see a company with shrinking sales trading at 40 times earnings, I run the other way. How does the analysis justify this?
Well, they aren't ignoring the bad data. They're interpreting it through a specific lens, which is the lens of a cyclical bottom.
A cyclical industry.
Right. You have to remember, solar is a lot like semiconductors or memory chips. It has these massive boom and bust cycles. And there's this weird counterintuitive rule for investing in these sectors.
Which is?
Cyclical stocks often look their most expensive by PE ratio right at the bottom of the cycle.
Wait, say that again? Most expensive at the bottom? That feels completely backwards. Things are supposed to look cheap at the bottom.
In a normal, stable business, yes. But think about the math of PE. It's price divided by earnings. In a downturn, the E, the earnings, it collapses. It can drop 90%. So even if the stock price gets cut in half, the ratio itself skyrockets because the denominator, the earnings, just vaporized.
Ah, okay, I see where you're going. The E becomes so tiny that it makes the P look huge by comparison. It's a mathematical distortion.
Precisely. The analysis calls it the trough multiple. It's a temporary distortion. And the argument is that the market isn't pricing ENPH on the depressed earnings of 2025.
2025 is a write-off.
It's a total write-off. It was the inventory correction year. The market is looking past that, and it's pricing the stock on the normalized earnings power of 2026 and 2027.
So it's a purely forward-looking rally. Investors are saying, we know 2025 was a dumpster fire. We don't care. We're betting on the recovery.
Correct. And that gets to the psychology of that huge green candle on the chart. That jump wasn't because the Q4 numbers were miraculous. They were good, but not that good.
It was the certainty.
It was because the report provided certainty. The market just paid a massive premium for the answer to the question, is the inventory destocking finished? And the answer was yes.
It's the reset. The fear of the unknown is gone. But how do we know the bottom is in? Because I've heard CEOs say that plenty of times right before the stock drops another 20%.
And that is a very valid skepticism. Talk is cheap. And that leads us to the first pillar of the bull case in this analysis. And it's about, the most boring topic in the world, but the most important right now.
Inventory dynamics.
Inventory dynamics, specifically sell-in versus sell-through.
Okay, I always get these mixed up. Break this down for us. Like, what is actually happening with the boxes in the warehouse?
It's critical. So sell-in is what ENPH ships to its distributors, the warehouses. This is the number that shows up as revenue on ENPH's income statement.
Got it. Sell-in equals revenue. Money in the door for ENPH.
Right. Now, sell-through in what those distributors actually sell to the installers, the guys in the vans who climb on your roof. Sell-through represents actual end-user demand.
So sell-in is filling the warehouse, sell-through is emptying it.
Perfect analogy. Now, for the last 18 months, interest rates went up, demand slowed down, but the warehouses were still stuffed with ENPH's microinverters from the boom times.
So the distributors are sitting on a mountain of boxes saying, whoa, stop shipping us more stuff.
Exactly. So ENPH had to drastically cut their sell-in. They were under shipping demand. Even while installers were still putting panels on roofs, ENPH wasn't shipping new product.
So their revenue looked awful because they were artificially holding back shipments to let the channel drain out. They were starving their own revenue line to fix the plumbing.
Right. It created a massive drag. It made the company look like it was shrinking way faster than it actually was. But, and this is the kitchen sink moment the analysis points to, the Q4 2025 report confirms that dynamic is over. The plumbing is clear.
And we have numbers to back that up.
We do. They reported revenue of $343 million. That beat the estimate of $335. But the real star here isn't the revenue number. It's the other number.
A sell-through.
The sell-through. The report notes that installations by the pros were up 21% quarter over quarter.
Wait, 21% up? That's not a small tick. That means homeowners are actually starting to buy solar again.
It is a massive signal. It means real demand is waking up. And because the warehouses are finally empty, we get to use the analogy from the report that I love.
The faucet.
The faucet. Think of ENPH's revenue as water from a faucet. During the correction, the faucet was crimped, they restricted the flow. Now the tank, the warehouse is empty. The mismatch is over.
So starting now, in Q1 2026, every panel installed requires a new microinverter to be shipped immediately.
There's no more buffer. Real demand now equals real revenue.
That creates a kind of mathematical slingshot.
Exactly. Even if end-user demand just stays flat, their revenue will jump because they're no longer under shipping. The artificial suppression is gone.
Okay, that's a huge shift. So pillar one, the inventory nightmare is over. What's pillar two? This one seems less about plumbing and more about, well, survival.
The last man standing.
Right. The report calls them that and talks about a competitive moat, but not a tech moat, but cash moat.
Because in a bear market, cash is king. If you run out of cash, you die. It doesn't matter how good your tech is. If you can't pay your suppliers, you lose.
And the number here is pretty stunning.
It is. ENPH ended 2025 with $1.1 billion in cash.
$1.5 billion.
In cash.
After the worst year in solar history. How is that possible?
That's the key differentiator. They managed their margins so tightly they actually paid down debt and remained free cash flow positive. They were making money while the industry was on fire around them.
That is just incredible operational discipline. And the analysis contrasts this pretty sharply with their main rival, SolarEdge, ticker SEDG.
Yeah, you can't talk about one without the other. They're the Coke and Pepsi of this space. But Pepsi had a very, very different winter.
A much colder winter, it sounds like.
Much colder. While ENPH was stacking cash, the report describes SolarEdge as struggling with negative margins and significant cash burn. They are bleeding cash just to keep the lights on.
So in this duopoly war, one has basically won by just staying financially sound while the other is wounded.
It's a war of attrition. And ENPH outlasted them, and that drives investor behavior. The analysis says people are flocking to ENPH not just for growth, but for safety. It's a flight to quality.
Which leads to the comparison in the report that really caught my eye. They call ENPH the Apple of the solar sector. Is that fair, or is that just marketing fluff?
It's ambitious, for sure, but functionally it kind of holds up. Think about Apple. Fortress balance sheet, sticky ecosystem, and massive gross margins.
Okay.
The report notes ENPH has gross margins around 46%.
46% in hardware. That's insane. That's software territory.
Exactly. For physical boxes that go on a roof, it's unheard of. And that supports the valuation argument. You pay a premium for Apple because it's safe and high quality. The argument is ENPH has earned that same quality premium in its space.
It's the safe harbor stock. Which actually transitions us perfectly to pillar three. This is about what's coming next, the guidance shock.
And this is so crucial because markets look forward. That 38% move wasn't about Q4. It was all about the guidance for Q1 2026.
And Q1 is normally the slow season, right? It's
Yeah.
literally winter, snow on the roofs, not a great time to be installing solar panels.
Correct. Q1 is historically the weakest quarter. Wall Street was braced for a disaster. The consensus estimate for revenue was what, $262 million?
A pretty low bar.
A very low bar. And ENPH didn't just step over it.
They smashed it.
They guided for $270 to $300 million. That is a classic beat and raise.
And Wall Street loves a beat and raise. It's the golden ticket.
It is, because what that signals is that demand is recovering faster than the macro data suggests. ENPH is on the ground saying, we see customers coming back now.
There was one little detail in there that I found really interesting. The report mentions 20 million plus in safe harbor revenue. What exactly is that? It sounds vaguely illicit.
No, nothing shady. It's actually a very powerful positive signal. Safe harbor in the solar industry refers to the investment tax credit, the ITC.
Ah, okay. Government incentives.
Right. To lock in a certain tax credit percentage, companies have to buy their equipment by a certain date. So safe harbor revenue means large commercial installers are pre-buying equipment in Q1.
For projects they plan to build later in the year.
Exactly. It's a leading indicator. You don't spend $20 million on inventory in January unless you're very confident you have projects to build in June and July. It's a vote of confidence from the people with the order books.
Okay, let's recap the 3 pillars. 1, the inventory glut is gone, the faucet is open. 2, they're the apple of solar with a fortress balance sheet. And 3, they guided higher, signaling a faster recovery, backed by real commitments from installers.
When you stack all 3 up, that irrational 38% rally starts to look a lot more rational.
It really does.
Yeah.
So that brings us to the verdict, the big question. Is that 40x PE justified? The analysis concludes with a pretty definitive yes.
Yes, because you were paying 40 times trough earnings, not normal earnings. You're paying for a company entering what could be a massive new growth cycle as interest rates stabilize and electricity prices keep climbing.
But the report also gives some tactical advice. It warns you, don't chase the candle, which I think is just good life advice.
It's very wise advice. After a 38% jump, the stock is technically overbought. The short squeeze runs out of steam, profit takers step in. You don't want to buy blindly at $52.
So it suggests watching for a retest. What are the key numbers we should be watching?
The analysis points to a buy zone around $45 to $48. If the stock pulls back to that level, the report suggests that's the opportunity. Let the euphoria settle.
Okay, so don't FOMO in at the top. But if this thesis holds, what's the upside?
The report sees a clear path back to $65 to $70 by the summer.
65 to 70. That would definitely confirm the solar winter is over. It really paints a picture of a company that has not just weathered the storm, but is now ready to sail.
The last man standing. It's a powerful narrative, and narrative drives price.
It is. You know, before we wrap up, what's the broader lesson here for someone listening?
I think the lesson is about the danger of looking at a single metric in isolation. If you just looked at the PE ratio or the negative revenue growth, you would have sold this stock. You would have missed the whole thing.
You'd be driving while looking in the rearview mirror.
Exactly. Context matters. Understanding the inventory cycle, the balance sheet, the difference between sell-in and sell-through, that's where the real edge is. The ratios are just shortcuts.
Such a good point. The numbers tell you what happened, not why it happened or what will happen. You have to look at the plumbing.
The plumbing is usually where the truth is hiding.
So we've established ENPH looks like the winner here.
Yeah.
But this leaves me with one last question, a bit of a provocative thought for you to chew on.
Let's hear it.
If ENPH is the last man standing because they survived the winter with cash in the bank, what does that say about everyone else in green tech?
Oof. That is the scary question, isn't it?
I mean, are we really seeing a broad recovery? Or is this a winner-take-all scenario where ENPH recovers while the rest of the sector gets left in the cold?
It's entirely possible. A rising tide lifts all boats, but not if some of those boats have holes in them. If the competition has been decimated, ENPH might not just recover, they might dominate.
It might be that the solar winter was the best thing that ever happened to them. Cleared the field.
A fascinating dynamic.
Something to chew on as you watch those tickers. Well, that's it for this deep dive into ENPH. Thanks for listening, and we'll catch you on the next one.
Stay curious.
See ya.
Don't forget to like, share, and subscribe for more.